In business, everyone wants to know one thing: are we making money? But the answer isn't just the balance in your bank account. To see the true story of performance, we turn to the most watched document in finance, the income statement. Also known as the profit and loss statement, or P&L, this report is a financial movie. Unlike the balance sheet, which is a snapshot of a single moment, the income statement tracks everything that happened over a specific period, be it a month, a quarter, or a year. The logic is simple. You take everything you earned, subtract everything you spent to earn it, and what's left is your profit, or your loss. But within those three categories lies the strategy and health of an entire company. We start at the very top. This is why revenue is often called the top line. It represents the total amount of money brought in from selling goods or services. It's important to note that under accrual accounting, revenue is recorded when the service is provided or the product is delivered, not necessarily when the cash hits the bank. If you sold $10,000 worth of consulting today, but won't be paid until next month, that $10,000 is still top-line revenue today. To make money, you have to spend money. The first thing we subtract from revenue is COGS, or cost of goods sold. These are the direct costs of producing what you sell. For a bakery, it's the flour and sugar. For a manufacturer, it's the raw steel and the factory labor. Subtracting cost of goods sold from revenue gives us gross profit. This tells us how efficient a company is at producing its core product. If your gross profit is too low, it doesn't matter how many units you sell. You'll never have enough left over to pay for your office or your staff. Now we move into the below-the-line costs. These are operating expenses. These are the costs required to keep the lights on and the business running, regardless of how many units you sold today. This includes selling, general and administrative, salaries for office staff, marketing campaigns, and rent, research and development, or R&D, investing in the products of tomorrow, depreciation, the invisible expense. This accounts for the wear and tear on your equipment and buildings over time. Once we subtract operating expenses from gross profit, we reach operating income, also known as earnings before interest and taxes. Many investors look at a variation called earnings before interest, taxes, depreciation, and amortization. This is often considered a pure look at a company's ability to generate cash from its operations, stripping away the complications of debt and accounting maneuvers. We're almost at the finish line, but the bank and the government need their share. That are interest expense. If the company has loans, the cost of that debt is subtracted here. Taxes, income tax owed to the state and federal government. After every employee is paid, every bean is accounted for, and every tax dollar is reserved, we arrive at the bottom line, net income. If this number is positive, the company is profitable. If it's negative, often shown in parentheses, the company is in a net loss. This is the number that determines if a company can pay dividends to its shareholders or if it needs to reinvest in itself to survive. A single income statement is a great start, but the real power comes from comparison. Horizontal analysis, comparing this year to last year. Are sales growing? Are expenses rising faster than revenue? Vertical analysis, expressing every line as a percentage of revenue. If your net profit margin is 10%, it means for every dollar you bring in, you keep 10 cents. The income statement is more than just a list of numbers. It's the narrative of a company's journey through the marketplace. It reveals the struggle between earning and spending, and it highlights the efficiency of management. Whether you are a small business owner, a stock market investor, or just someone trying to understand the world of commerce, mastering the profit and loss is your key to understanding the heartbeat of business.